Hi, I'm Randy Schramm, an audit partner with Marshall Jones, and in partnership with the Georgia Center for Nonprofits, I'd like to welcome Ashley Carson. She's a nonprofit and business banking executive at the Atlanta Capital Bank and has a lot of great experience working with a lot of great nonprofits out there. And what we like to do is gather her best practices as we talk about now our third session, talking about questions that many members of the Georgia Center for Nonprofits are probably already asking themselves, especially as they're looking at their own banking relationship. The first question has to do about capital campaigns. And many times we know that that's going to be a part of bridge financing. So can you help us talk about how would a bank approach you about securing a capital campaign bridge financing loan?
Sure. So there are actually a lot of steps that a nonprofit needs to do and information they need to gather before they even start engaging with a bank about a bridge loan. And just for those of you that don't know what a bridge loan essentially is basically a bank is looking at the pledges that an organization is collecting over a certain period of time. We're looking at those pledges as a source of repayment for our loan. We're also taking them as collateral. And so those pledges basically are going to be collected over that time period, and we will advance on a loan based on the dollar amount of those pledges up to a certain amount. Depending on the quality of pledges, where the pledges are from, the due diligence that we do on those pledges as a bank will determine the advance rate on those pledges. Typically then, a bridge loan looks something like a reducing revolving line of credit. So as an organization is actually collecting cash, they can use cash first, and then they can draw on the line of credit secondly, so that they can minimize their interest expense. So before a nonprofit even approaches a bank to talk about a capital campaign or bridge loan, there are actually some things that we want them to do beforehand. A best practice, first and foremost, is to engage fundraising counsel. Executive directors, board of directors, some of them are very good at raising money, but having a multi-year capital campaign with numerous pledges requires a different kind of expertise. And we have some wonderful resources of fundraising counsel firms in Atlanta and outside throughout the United States to really help people identify which foundations they can go to and then really organize how they're going to approach them and obtain these pledges from foundations. Also, fundraising firms really help a lot of nonprofits think about how they're going to get financing from their stakeholders, from individual givers. There are so many different sources that you go to when you're having a capital campaign, and it's so important that you have kind of a bird's eye view of these are all of the different elements of giving that we need to be thinking about as we're putting together a capital campaign. The next important thing that a fundraising firm will be able to do for a nonprofit is run a feasibility study. And this is actually a series of questions that they actually ask stakeholders in the community that ask, is this project something that you would actually give to yourself? Is this something that makes sense for the community? Because we want to make sure that not only does this align with the mission of the organization, but it's something that people are going to want to give to. Also, the feasibility study gives us a lot of information about not just who they've approached and the answers that the fundraising firm has gotten in the community, but really how much money they think they're going to be able to raise. Before anyone ever comes to us for a bridge loan, the other thing I would always say is that we do not like to lend to capital campaigns unless the majority of the pledges are in place before we put the bridge financing in place. And so the one thing that we would never want to see happen with a nonprofit is that they don't collect all of their pledges and they actually aren't able to repay us. And so it's so vitally important. We want to understand that the organization isn't going to be pulled in different directions and struggle with repayment of the loan, and that the pledges are there in place, and that the project is actually going to be able to be completed, and that this whole series of things will come to fruition and be successful.
Okay, Ashley, let's now talk about maybe commercial funding, another form of funding for nonprofits, especially if they either are renting a building or see a building that they think is going to be a perfect fit for them and their mission. And maybe they've got an older building right now, and they've got a major renovation out there. How would they go about approaching you and Atlantic Capital Bank about the best way to move forward with getting a renovation for a new or existing building?
Yeah, and even before they get to that point, Randy, it's always interesting to have that conversation about lease versus buy, which I know is something that you engage with a lot of your customers about as well. What are the implications of owning the building? What are the implications of leasing it? And how is that going to affect our cash flow? So when you think about a commercial mortgage, Randy, as you know, the sources of repayment are a little bit different when you're looking at term debt that gets amortized over a period of time. You know, that's really when we're looking at the cash flows, the historical cash flows of an organization, and understanding how those historical cash flows look in order for us to have debt service coverage of this term loan going forward. So it's really important whenever an organization is thinking about acquiring term debt to make sure when you come to a bank that you're bringing really good financial statements. We love audited financial statements, as I've told you in the past. And then the ability for an organization to say, in the past, we've had excess amount of cash flow, and this is the cash flow that we think is going to go to repaying the debt. Or we're going to be replacing rent, and this is the rent savings that we'll have that will be able to go towards paying for the debt. And so it's just really important to think about how these cash flows work. So looking historically, and then also looking forward, and being able to have a pro forma for a bank to say, this is what we expect operations to look like based on her historical operations, and this is how we anticipate repaying this mortgage over a 5 to 10 year time frame.
Through a cash flow projection, then.
That's right, a cash flow projection.
That's very helpful. And Ashley, finally, now let's talk about liquidity. As an auditor, I know there's a new financial reporting standard out there. It's a couple years old now that now introduces this concept of liquidity in the footnotes of our audited financial statements of the nonprofits. And what it does, it describes liquidity both in a quantitative and a qualitative standpoint. Of course, for-profit entities don't have to worry about this, but nonprofits do. And a lot of times I've heard this referred to as the Goldilocks rule. Sometimes that they're handing their financial statements to a potential user or potential donor. The worry is this liquidity number, is it too high? Does that mean, boy, I'm not going to get any funders that want to give to my organization because this liquidity number is too high? But more often, they're worried about this liquidity number being too low, which could often reflect on the management of the organization. So more often I get the question, how can I increase this liquidity? I didn't realize how important this was. What are people asking me about this? How can I increase it? So when you hear those type of questions from your clients, how do you approach them?
Well, I would say that I'm excited about this new rule because it actually provides us some more clarity on liquidity as well, which is always what we're looking for as cash flow lenders. As a bank, we love cash, and so cash is king, and I know that everybody's heard that before. And so oftentimes people get frustrated because they say, well, a bank won't lend to me when I actually need the cash. But the stability of an organization is really, you can tell it very quickly by how much cash they have. And really well-managed organizations have cash operation reserves so that just in case they hit some bumps in the road, they don't have to turn around and go to a board or look at a bank and say, I need some working capital. Working capital liquidity with a bank can be pretty tricky because working capital lines of credit are really aligned with a short-term asset. And a short-term asset that we would lend to and use as collateral for a working capital line of credit would be a receivable. Well, nonprofits are so different because their receivables are oftentimes non-existent. People give directly or it's a grant. And it's not like a bank's gonna look at a foundation and say, well, you have to pay that money, or government receivables in the same case are really hard for us to lend on because we really don't have any recourse on the US government to be able to get paid back. And so we do a lot of working capital for nonprofits, but it's actually even harder to underwrite than some of a term loan or a bridge loan, because we really have to understand the daily inflows and outflows of cash, and that the organization is really able to manage that. And when an organization needs that working capital line, it means that they usually have a pretty tight cash position, which means that it's probably a little bit more of a risk for a bank to lend to them.
Would you recommend then a nonprofit approach you before they actually need it?
I would recommend that they get a working capital operating line before they need it.
Okay.
Develop a relationship with a bank, and then oftentimes, if a bank can't help an organization with a working capital loan, a lot of times they can go back to board members or to foundations and get someone to put up collateral, like investments, or go to the community foundation and work with them in order to provide the bank with something that we can lend on, like a pledge receivable or a guarantee, in order to get a working capital line of credit. So there are a lot of creative ways to do this, Randy. And I guess the most important thing is what we've always been talking about through all of these, is that it's all about the relationship. Building the rapport with your banker, leaning into them as part of your brain trust so that you can ask them questions and they can give you some good
communication, yes,
advice.
Throughout the year.
Because it's complicated. And as I said, nonprofits all are so different and managed so differently. And so it's even more important that they have people like us that are able to really help them and help them find some answers and solutions for what they're looking for.
Well, that's great. Very helpful. Thank you.